Check at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
What you'll see in the United States and the UK is disastrous data will show, and central banks will then move into panic mode as the markets are pricing in already.
They've got to show that they can manage both this as well as a crisis and confidence within the regional banks.
Banks are really where the rubber meets the road in terms of taking financial policy and pushing it into the real economy.
As the banking situation hopefully calms down, the data will become more important.
The conversation is going to have to shift, I think, in the next few weeks towards what does the path to the next 1 to 2 years look like.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I usually start Friday by saying, let's get you to the weekend, but the last 2 weekends have not been much of a weekend.
So you don't want another one.
Let's get you to a better weekend. From New York City this morning, good morning, good morning. This is Bloomberg Surveillance for our audience worldwide on TV and radio. Equity futures down about 8 or 9/10%. A couple of names to stay on top of this morning. Deutsche Bank is one, down 14%. UBS right now, Lisa, down 6.7%. First Republic was a little bit softer earlier. I'd call that unchanged on my screen relative to what we have seen over the last few weeks.
I would agree with those shares still trading with a 12 handle in terms of how much they've fallen. If you take a look at some of the other regional bank stocks in the U.S., also under pressure, whether it's PacWest or whether it's Western Alliance. Why? Right? What happened, John, to really trigger ongoing selling? And this is the difficulty right now that we're having, is we don't have a sense of where the risks lie, but the tea leaves, whether it's balance sheets or other data, highlight that there still is enough stress that banks are borrowing from federal authorities.
Well, let's talk about that stress and push it through the bond market. When you have stress and push it through bonds, get a big rally. 2-year yield down 24 basis points, sub 360, Lisa, on a session. Right now, 359. 10-year down 13. Call it 14 basis points. 10-year right now, 329. What a move.
So a month ago, 2 months ago, we were talking about the potential for a 5% Fed funds rate as late as January of next year. Now we're talking about a 3.5% Fed funds rate as of January next year. There has been a complete repricing in terms of how much the Fed is not going to have to just hike rates or not hike rates, but how much they're going to cut in the face of some of the stress that we're seeing in the banking system. Now, again, officials are not saying that this is the case. And you've asked a really good question. You've picked up on this and asked it again and again. Are rate cuts good for risk assets in an environment where it means that the economy and the credit tightening is doing the work for the Fed?
Not all rate cuts are created equally. If you had projected rate cuts because you believed we were going to get that immaculate disinflation and the Fed could back away, great stuff. Markets should rip. The economy is going to be great. If you're cutting interest rates because things are breaking, I'm not sure things are great just yet. And the people who want to play the recovery, I think the point of tension for me, and the point of tension that I'm asking a lot of questions about, and Lisa Levine was great earlier this week of BNY Mellon on this. She was talking about the trade after the trade. You know, the recovery to the recession we've not had yet. Do you want to start playing the recovery before you've actually seen the recession and the price action associated with it?
What I've seen the biggest change in recently is where people see the real yields going forward, and it is much lower. Does that give you a boost to risk assets? And I am curious when people start to think, okay, if the Fed backs away from rate hikes sooner, does that mean higher inflation for longer? How do we play that trade out if basically the stresses in the financial system cap the potential for how much this Fed can fight inflation when it still is an issue?
That's the wrinkle in the story.
Yeah.
There is just this belief that they'll back away because it is a disinflationary shock and we'll get rid of the inflation problem. When only a couple of weeks ago, people were on this program saying there was a secular component to the inflation story. It was sticky for longer. It was higher for longer. You're as frustrated as everyone else is with this story as the NASDAQ has just ripped over the last couple of weeks. The S&P right now is down about 1% on the S&P 500. Futures are a whole lot softer here. I'd say the dollar's a whole lot stronger too. The euro, negative 0.9%, 107.30, and a big rally in the bond market. Joining us now is Patrick Armstrong, CIO of Plurimi Wealth. Patrick, you've usually got a really interesting trade. I know you were short Credit Suisse and you held some of the debt. Let's start there. Walk me through how that worked out.
So I was short Credit Suisse all of last year. I actually closed my short, unfortunately, at the beginning of March. So I covered it at 290s. Important company, bonds couldn't fail. So had a bit of a scary ride over the weekend.
I'm sure you did.
Some of the bonds I own are senior bonds, all senior bonds, but at the group level. And there were scenarios where if it was a forced asset sale and UBS didn't buy the group, those bonds would have come under pressure and potentially even been worthless. But it's turned out to be a good trade on both sides of those. Since we've closed Credit Suisse, though, we're actually short Bank of Nova Scotia in Canada now. And the Canadian banks became the biggest banks in the world in the financial crisis. They weren't impaired basically by the same issues that saw all the other banks plummet in value. And I think they're viewed as a beacon of safety, but Canadian banks have a property bubble to deal with, and they've got rising rates to deal with, and they're very expensive. You look at every other bank in the world, and they're trading at fractions of tangible book value. In Canada, they're still trading at multiples of tangible book value. So very expensive banks, very well-run banks, but with a property bubble, that creates some risks.
Well, let's put some numbers on that property bubble. Patrick, how bad is that situation?
Well, property, it's always very hard to exactly quantify, but affordability index, Canada's right near the bottom of the world. Property prices have gone up 400%. Incomes are rising in line with the rest of the world. So zero interest rate policy that led to property price jumps everywhere just were really magnified in Canada. Canada has big commodity exporter as well. So in high oil prices, the economy was relatively resilient, and zero interest rate policies have led to incredibly strong property market, especially in the big cities.
Patrick, I'm going to help you out. Disclosure, you're from Canada, right? So this is some coming from a place where you can criticize your own home more easily. I am curious of whether this is just a symptom of liquidity being drawn out of the system that is exposing other areas as overly inflated that have not gotten repriced down, where you see a potential trade.
Well, it's a combination with Bank of Nova Scotia. It's expensive versus other banks, very high on book value, higher on earnings, and you are going to see impairments on its loan book because banks, their business model is you lend money to people to buy houses. If those house prices come back to normal on any measure versus history, you're going to have bad debt in Canada.
But it's not just a Canadian story. I mean, aside from just real estate, and there are issues or pockets of issues in the Scandinavian countries and other areas where there also is an affordability problem, it's also in private equity. It's also in private debt. We have seen this. We've heard this from a number of different people. And then others push back and say, well, it's either repriced or it won't have to reprice because the assets will return to their value later on. Do you think that that's fair, or do you think that there are pockets, nodes of potential contagion, should there be some forced sale, some price discovery in some of these assets?
Yeah, private equity investors are generally not forced into sell, but if you mark to market properly, there's no way private equity dodged the sell-off in treasuries, the sell-off in equities, the sell-off in every asset in 2022. But private equity funds mark their assets down 6%, some of them things like that, but those aren't realizable levels. So I don't want to just talk about shorts, but I'm short EQT, which is a private equity, a lot of private equity assets. I'm short SoftBank, which was a play on higher interest rates and companies that have no path to profitability. But it is also tying into what you just said about marking to market versus marking to what you want to market at.
So, Patrick, tell me about the longs, since you don't want to talk about the shorts too much anymore. What's your favorite long right now?
My favorite long, I like BBVA. If we're talking about banks especially, that's a company that's going to grow its revenue probably at 15% minimum this year. They've told the regulator they expect to grow revenue at 25%. Interest rates aren't zero anymore. That was a big headwind to their profitability. So I'm not anti-bank. I think some of the banks make sense. I like to pair longs with shorts. BBVA, I think, is very attractive value right now.
The ECB's coming out swinging, talking about more hikes. You heard the German central bank governor saying the same thing, maybe even speeding up QT in 3Q. You think that's achievable?
Well, you've got to measure price stability, which they're worried about, but financial stability, I think, is first and foremost in all the central banks where it should be right now. And I actually think we probably aren't going to get as hawkish response as we probably would have otherwise. and it's going to sow the seeds for future inflation down the line, because central banks' playbook, when there is financial stress, throw liquidity at it. And you've got conditions tightening that are offset by the liquidity they're throwing right now. So it's not inflationary right now, but they have a tendency to leave those policies in place a little bit longer than they should. So I think inflation's really dying out quick right now, but I think it's probably got another leg up in response to what's going to be happening from central banks in the coming months.
What's the growth profile associated with that inflation call, Patrick?
Growth. So I think the U.S. is probably going to fall into a technical recession, probably just based on the tighter financial conditions, less access to credit. My view was a month ago it wouldn't, and my view is now that it probably will, but I think it's going to be relatively minor. The employment situation is still robust. Employment's always a lagging indicator, but 1.6 job openings for every unemployed person, that's going to change a lot before you see a meaningful disruption to the U.S. consumer.
Patrick, fascinating to catch up. Great call on Credit Suisse as well. Patrick Armstrong there of Plurimi Wealth. I'm sure he hoped he'd held on for another 2 weeks onto that short, but 70% move.
Yeah.
That's a pretty big move.
Yeah, he did pretty well for himself. What you asked there I thought was important. What growth profile is associated with that kind of inflation over the longer term and that increase that you might see in stimulus? A lot of people calling for stagflation.
Can we put the stagflation?
Right. And that's, I think, where a lot of people are concerned about where do you go if you have that kind of environment, if basically central banks are forced to throw money at a problem that really is driven by the financial system, and then it leaves us back to square one again in terms of fighting inflation.
The call on Canada is interesting, isn't it?
Yes, it is.
It's not just Canada, and it's not just equities. It's not just banks. We've had the FX call being associated with the property bubble as well, haven't we?
Exactly, that basically you want to go into a place where they don't necessarily have to see a pretty significant decline in home prices. Again, the FX analysts are becoming experts in whatever is the narrative du jour, and right now it's where are the nodes of contagion and where are the mispricings in the market.
When Lisa's talking about nodes of contagion, you know it's a bad day. Futures are down 0.9%. Deutsche Bank's down 14%. UBS is down 6%. First Republic is down about 4.5%. And this bond market is rallying hard. Your 2-year, 358. Your 10-year, 329.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. U.S. prosecutors have charged Terraform Labs co-founder Do Kwon with orchestrating a massive cryptocurrency fraud. It's said to have wiped out at least $40 billion in market value. Kwon was already a fugitive from charges in his native South Korea. He was arrested Thursday in Montenegro. Deutsche Bank has become the latest focus of the banking turmoil in Europe. Shares fell, and the cost of insuring against the German lender's default rose. Deutsche Bank has staged a recovery in recent years after a series of problems. Today, it is said it would redeem a Tier 2 subordinated bond early, a move intended to give investors confidence. In Japan, inflation slowed for the first time in more than a year. Consumer prices, excluding fresh food, rose 3.1% in February from a year ago, down more than a full percentage point. But without the impact of government subsidies for energy and travel, inflation would have been as high as 4.4%. Ford is raising its projection of how many electric F-Series pickup trucks it can build at a factory under construction in Tennessee. The new estimate, 500,000 a year. Now that's about 40% more than the company forecasts in November. The Ford factory is due to open in 2025. Hundreds of funds reportedly will lose their ESG ratings at MSCI. According to the Financial Times, MSCI is also planning to lower the environmental, social, and governance ratings of thousands of funds. And the move comes amid growing concern that the ESG label is applied too easily. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
We obviously are watching it very carefully. We've been very heavily involved in the last 2 weeks in all of that. And I'm encouraged by the signs in the UK banking system. I think we've got a banking system that is safe and sound. And of course, it's one that people can rely on. That's the thing we must have, is a banking system that people can rely on. Now, I'm optimistic on that. I do think the banks are in a strong position in this country.
Rinse and repeat, that was Governor Bailey, but that's been pretty much everyone worldwide. Europe, the UK, the United States. Pick your country, and as a finance minister, a central banker somewhere, saying their financial system, Lisa, is robust and your deposits are safe.
Even Australia, the
Same
head
thing.
of the governor of the Royal Bank of Australia, coming out being like, Reserve Bank of Australia, excuse me, coming out and saying, our system is strong and people aren't buying it. And so what's it going to take?
Right now, bank stocks are lower. First Republic's down 4.5%. Over to Europe, UBS is down about 6% over in Swiss trading. Deutsche Bank's down 14%. Maria Tadeo is in Brussels, where finance ministers are meeting, and Maria joins us now. Maria, what's on the agenda here?
Well, Jonathan, this was all supposed to be about the economy, but I can tell you it's been absolutely blackout. Nothing has leaked. We know that in this meeting, where, by the way, Madame Lagarde, the head of the ECB, met with European leaders, the 27 of them. It was a meeting behind closed doors, no phones allowed. Obviously, the information there is being kept very tight-lipped. There was supposed to be a final press conference today with the heads of both the European Commission and the European Council. We hear that has been canceled now, but remember, up until now, the message from the European Central Bank has been there is no trade-off between price stability, financial stability. We can handle both, and we'll do both. But obviously, for Europeans today, what a cold shower. And Jonathan, just how sentiment flips so fast. Yesterday, I was speaking to one of my sources, and he said to me, you know what? I feel the worst of the storm for Europe is over. Everyone understood our banks are well capitalized and well regulated. You come in this morning, you look at this banks, and the picture today, it's not a pretty sight.
We were talking a lot this morning, Maria, about U.S. leaders and the aversion to being associated with any additional bailout in the post-2008 world. How much does that cohere with the rhetoric that you're hearing from European leaders over there in Brussels?
Look, it's a very difficult question to answer because we have not really had any access to European leaders. Usually this is a place where you scream and chat questions. You do get information. Obviously, you have to hustle a lot on the sidelines to get access to what's being said behind closed doors. But this one, to me, what I'm struck by is the fact that it has been so well protected, the information of these discussions about the state of the economy and obviously by implication and extension, the banking sector. We are waiting for a number of countries potentially to brief us, but overall, not a lot has come through out of this. The standard line, however, up until yesterday was, again, European banks are strong, they're well capitalized, they have liquidity, and they are well regulated. But obviously, the market today, very jittery.
This market's all over the place. Maria, thank you. Maria Tadeo there out of Brussels. Joining us now is Bloomberg's Jan-Patrick Banner. Jan-Patrick, wonderful to hear from you, as always. Deutsche Bank's down 14%. Lisa and I discussed it through this morning. Scratching our heads and saying, why? What's the news here? Where is the news? What is the why?
Well, to me, it's not a thing about like Deutsche Bank on its own. It's just like a kind of a random move. I would even say, like last week we had like Societe Generale or BNP being the worst performers. What we're seeing today, to me, is like it's a pure recession trade, and you see this across the market, right? From sectors ranging from banks to energy to autos to construction in Europe. You see quality factors being in demand while low quality factors are being sold off, and of course. if you have a bank like Deutsche Bank, who is like hugely exposed to corporate lending, and then especially to Germany, which is in turn exposed to the global economy, it's a stock that you're selling more than others if you are repositioning for this hard landing story that we are seeing over the past 2 weeks now. So to me, it's not about like Deutsche Bank being in trouble or anything like that. It's more like the market, again, picking up that story of a hard repositioning of the economic narrative.
Well, this really raises this issue of Joachim Nagel, the head of the Bundesbank, coming out earlier this morning with pretty hawkish rhetoric, and whether this hawkish rhetoric only accelerates the sell-off that we're seeing in some of these recession trades that you're talking about. Are you connecting the dots there, that the more some of the ECB officials lean into we have a lot more to do, the more that basically rate hikes are priced out in the whole region and recession's priced in?
Well, absolutely. And I think like the central banks need to be very careful there. I understand that the Fed as well as the ECB both said like, okay, we are focusing on inflation. The job is not done, and we are not want to create the impression that we have to tap the brakes here immediately, because that would then send the signal that there's something bigger wrong in the system. But still, I feel like that the speed of which this breakdown in economic activity and with that inflation has accelerated a lot in the last couple of days, and central banks certainly need to take that into consideration going forward with their rate path, that the job that they are trying to achieve might come in much, much quicker than they actually anticipate, and then that they need to move quickly from breaking inflation to supporting the economy. And that's a very difficult thing to do for them, and they need to be very careful, I believe, in their action that they're taking over the next couple of weeks and months.
Yeah, and a lot of people are going to listen to this and they're going to say, okay, we understand the recession trade, but ultimately, why is Deutsche Bank down 11% on no news? Is that really simply because people are forecasting that there could be some sort of downturn in the future, which has been on the table for a while? Yeah, and how much are people looking at actual serious issues with counterparty risk, with the potential for the flight of, contingent capital bondholders, other types of contagion effects from not only Credit Suisse, but just in general what we've seen across the banking complex?
Well, I don't want to sound naive here. And of course, there's always in the banking sector, you have an issue when the economy is slowing. You have a lot of credit exposure on your books. You are based in the country in Europe that has the biggest exposure to the global economy. I don't want to be naive in saying like there is no issue at all. But for the moment, to me, like this is a earnings trade. And of course, Deutsche Bank's earnings will be hit much harder than all the others. But we are not at a stage where this is a capital trade to me, where we like really see like massive problems within the capital position of those banks. And that's an important distinction I think we should make at this point.
It's a vital one. Jan Patrick, thanks for doing that. Jan Patrick Barnett there. I think that's a difficult one to make sometimes, though. When you see a stock down aggressively, you start thinking about existential risk. But clearly, there's a lot of daylight between existential risk and then just a pure profit challenge. And I think we can all agree if we can escape the worst of this, there's going to be a pure profit challenge for the whole industry in a big way.
Especially if the economy does have a recession. And if Europe is facing potentially more issues, right now, not so much. We got PMIs in the service sector earlier this morning that came out better than expected in Europe. But if that emboldens ECB officials to only hike rates more, does that send the downside even further south going forward in the future?
You know the one I don't get? Schwab. Schwab was down yesterday 6%. The CEO spoke to the Wall Street Journal, Walt Bettinger, and said there would be a sufficient amount of liquidity right there to cover if 100% of our bank's deposits ran off. So they're saying they've got all the liquidity in the world to deal with this, and yet the stock still finished the session lower, and I believe in a pre-market it's softer too.
This again goes to the profitability question, right? And at what point does this challenge the business model? Or it just isn't logical. But I mean, honestly, that's sort of what I keep coming back to. And at a certain point, when does the price action become a self-fulfilling prophecy in terms of credibility and just confidence from investors and from depositors?
Are we escaping this weekend without emergency meetings? Are we done with that?
I really hope so. I mean, honestly, this is the issue, is we don't know what we don't know. And hopefully there is some stability. The data suggested that. The data that we got yesterday suggested.
Sub 200K on claims. Who's paying attention to the data now?
Well, not just that data, but also, yes, correct. I mean, there seems to still be stability in the market, although that's backward looking. The data from the Federal Reserve showing that lending went down just a little bit from the Fed to some of these banks, but it still is very elevated. People think maybe banks have taken the funds that they need at this point so they can sit on that, and that might not signal as much distress. the money market funds, that's concerning to me because that means those are all deposits coming out of banks and going into money market funds. Well, that's going to really challenge loan creation and profitability.
That's a big pile of money. Coming up at the Open, Kelsey Barrow of JP Morgan Asset Management, George Goncalves of MUFG, Keith Lerner of Truist, and the brilliant Chris Mamani of Lafayette College. That conversation on Bloomberg TV in the next hour.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
About 1 hour before the open of U.S. trading, and it does look a bit softer as we await some sense of whether we can go into this weekend with some calm. Welcome back. This is Bloomberg Surveillance. John off to his next property. Tom Keene back on Monday. And right now, I'm Lisa Abramowitz taking a look at markets that are just soggy after trying to assess how much damage is being done. The real move, I think, this week has been yields so much lower, with two-year yields sharply under 3.6%. Right now, we do have some economic data coming out. Let's head over to Michael McKee, Bloomberg Economics and Policy Correspondent. Mike?
getting, Lisa, the February durable goods orders numbers. Now, remember, this is February. It's a little bit old, and it goes back to before the banking problem, although I don't know whether that would influence you to buy a new Boeing or not. But durable goods orders fall 1% after a 4.5% drop the month before. Ex-transportation is flat. And capital goods orders, non-defense ex-air, which is the one that economists watch because it's essentially a proxy for business spending, that one is up 0.2% after an 0.8 increase the month before. These are the non-revised numbers. I'm still looking for the revised numbers on those. But it looks like still a little bit of expansion in terms of business spending, but not a huge amount. With the headline number, and that's what I need to find here, what we usually see is it's heavily influenced by Boeing because those jets are really, really expensive. So I'll take a quick look here and see non-defense aircraft were down down 56.3% for the month of December and January. In January to February, they were down 6.5%. So Boeing taking a lot out of the first 2 months of the year, Lisa, but overall, the initial impression is it's not terrible, but this obviously isn't going to influence the Fed in any way since
or markets. I'll give you a chance to parse through some of it. Not seeing a big change in markets, but we've been talking all week about how economic data doesn't seem to matter nearly as much, with the focus very much front and center on the banking situation and whether we see more stresses emerge in the financial system, Mike. As we really think about that, it is important to question the underlying strength of the economy and underlying inflationary impulse, particularly on the services side. How much have you seen this ongoing divergence with weakness, downside surprises to the good side of the economy, even at a time when you continue to see upside surprises in services?
Yeah, and you look in the under the hood here of the numbers, and machinery orders were down, computer orders were down, communications equipment orders were down. So ultimately, this doesn't come out as good as maybe the headline would suggest. Not that it was great, but you have some of the key parts of the U.S. industrial economy seeing a slowdown in orders from business. So it's not as good a news as you might think. We also saw the prior month's numbers, the January numbers, revised down from 4.5 on the headline to -5 on the headline, and the capital goods orders shipments were revised down from 0.8% to 0.3% in January. So the number's a lot weaker than they had initially appeared.
Michael McKee, thank you so much for breaking that down. And next week, hopefully, we'll have a better sense of whether the economic data does matter again, given the fact that we are on tenterhooks trying to understand whether the banking crisis has been resolved. Pairing these ideas of the economic data and concern about loans being extended from banks, the potential credit impulse to the American population. Dana Peterson joining us now, chief economist at the Conference Board. Dana, I want to start by just asking, how much has your outlook for the U.S. economy changed over the past 2 weeks?
It really hasn't. We have been calling for a recession starting in the second quarter and extending through the fourth quarter. If anything, this might accelerate things. Certainly, consumers have already dialed back spending on goods. Businesses are not spending on investments. And also the housing market has really folded in on itself. And really the last shoe to fall is services. Now, a credit crunch really doesn't affect services because people don't tend to finance restaurant visits other than using their credit cards. But certainly, we think that in terms of durable goods and certainly the ability for businesses to invest, that tighter credit conditions are not a good thing for them, and that will potentially cause the economy to have maybe a little bit worse recession than we're expecting.
So that's what a lot of people are saying, is that this brings forward the recession. But you bring another specter to the table here, this idea of a potentially deeper recession. At what point do liquidity concerns at banks become a credit problem for the consumer, a credit problem for the economy, akin to what we have seen in history when there are liquidity issues?
Well, if you're a bank and you're concerned about your deposit levels dropping, you're less likely to lend money. But the thing is that consumers are already pulling back. They're not going out and buying cars and homes because interest rates have risen significantly, almost 5 percentage points in roughly a year. So there may not be much effect on the consumer, but certainly I think there's a risk for businesses who tend to need cash, especially to pay their workers and to invest in short-term and long-term ventures. So I think the pressures will probably be more on businesses relative to consumers.
Does this also shift your view on how much unemployment could go up, or do you think that we could get this downturn without some sort of structural increase in joblessness, just simply because of the mismatch right now in the labor market?
Well, the industries that are letting people go are the former pandemic darlings. Again, it's tech, it's finance, it's real estate, it's construction, it's transportation and warehousing, which were linked to the strong demand for goods. So that's what we're still seeing in terms of layoffs and weakness. But you still have these huge labor shortages in areas that are less sensitive to interest rates, such as healthcare and restaurants and hotels. So what we really need to see is consumers turn that dour sentiment that we're seeing in our consumer confidence gauge, which we've seen over the last year, into, okay, I no longer want to purchase services. And certainly higher interest rates may not get at that issue. But if consumers think, well, I might be next in terms of layoffs, then they'll pull back on spending. But all in all, we still think that the unemployment rate's probably going to rise to about 4.4% next year. That's roughly 1 million jobs lost. I would not want to be in that number, but certainly not as bad as what it could be.
We're speaking with Dana Peterson, chief economist at the Conference Board, as we look forward to another week, another month, potentially rate cuts in the face of what some people are expecting is a decline in economic momentum. Dana, here comes sort of the rub on the whole issue as we talk about perhaps a sooner recession, a deeper recession, and a Fed cutting rates in response to that. Have we dealt with the inflation problem, especially given the stickiness that we've seen in recent data?
I don't think we have. Certainly when we see the stickiness, it's linked to wages through, services through wages and very strong demand for services. Also food prices, which are being influenced by outside effects. Certainly the declines that we expect in rent inflation, it's in the pipeline. We just have to wait for it to happen. Maybe it'll start in the springtime or early summer. But I don't think we've licked the inflation problem. And so that's why we're not anticipating that the Fed's going to cut rates this year, even if there is a mild recession. If you still have prices that are so far above the 2% target, why would the Fed be cutting interest rates, especially if they also think that if there is a recession, that it's not going to be that bad?
Well, and this isn't just an interest rate story, it's also a balance sheet story. And we saw the balance sheet increase dramatically over the past 2 weeks in terms of the Federal Reserve and its holdings. And part of this is not necessarily stimulative, some people will point out. These are emergency loans to certain banks. At the same time, can this central bank kill inflation if it keeps going back to the same crisis-era tools to try to solve financial instability?
Well, I think the Fed is trying to say that it can do two things at once, right? It can address inflation through the credit channel by raising interest rates and also the continued dialing down of its balance sheet. But it can also provide liquidity, which, yes, does hit the balance sheet. But you can think about it as two different wallets that the Fed is working with here. And so the Fed is saying we can provide liquidity to banks, and it's not stimulative because banks are taking this money because they needed to make sure that they remain stable, but they're also probably not going to lend this money. So that prevents it from being stimulative or inflationary. So I think that's the key thing. We have to understand the Fed has many different tools. It's using these different tools in different ways, and that it can address inflation and providing liquidity at the same time.
How much do you think that the Fed can cut rates?
Well, again, we think there are no rate cuts for this year, but we'll probably start seeing consideration of rate cuts maybe in the second quarter of next year. But we think that we're not going to go back down to the low levels that we saw even before the pandemic, because inflation may be structurally higher and it may be more difficult for the Fed to maintain that 2% target. So we think that maybe the federal funds rate next year goes down to around 3.25%, 4%. But certainly not back to 2 or 1 or even 0 unless we have some major crisis or very deep recession.
Dana Peterson, thank you so much for being with us of the Conference Board. We were talking about the balance sheet, and I want to bring Michael McKee back in because we saw a massive increase in the Fed's holdings from $8.3 trillion to $8.7 trillion over just 2 weeks. Mike, what is the distinction between stimulative balance sheet expansion and non-stimulative balance sheet expansion?
Well, that's a really good question, Lisa, and a lot of people are confused about this. What's going on is the banks that have these liquidity mismatches on their balance sheets with assets that may be worth less because of higher interest rates are able to lend those to the Fed at par and get cash for that, which they can then keep in their accounts so they have enough money in case there are withdrawals. They're not going to be able to use it to make loans, and they're not going to be stimulating the economy with it. The loans are also temporary, 90 days through the discount window, a year through the new lending program, and so they've got to give the money back. So this is a completely different animal than the normal QE, where the Fed buys bonds, takes duration out of the market, and puts cash out there to be put to work.
Just 20 seconds, Mike. Does the data that we got yesterday indicate that banks have largely borrowed what they need?
We don't know. I would assume that we're essentially there because by now you would know if you were a banker, if you had real problems on the balance sheet, but it might take another week or two for all this to work out.
Michael McKee, thank you so much. As always, great work, and it's really important to keep watching the data. People are watching the data that comes out at 4:15 p.m. today, taking a look at what some of the loans are that banks are extending as we look for the Senior Loan Officer Survey next week. We are looking right now at markets on the move, lower, down almost 0.9% in the S&P, 39.43. Yields continue their descent. The 10-year yield, 3.3%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UBS and Credit Suisse are among the banks being looked at in a U.S. Justice Department investigation. Authorities want to know whether finance professionals help Russian oligarchs evade sanctions. Subpoenas also went to employees at some major U.S. banks. Credit Suisse and UBS both declined to comment. The CEO of Standard Chartered says the worst moments of the banking crisis are over. Bill Winters spoke to Bloomberg's David Ingles in Hong Kong.
I hope we're through the worst. I think there's still some questions around business models around the world. Have there been weaknesses that have been exposed in the business models of any of the companies that have had trouble that need to be addressed at this point? But it certainly seems that the acute phase of the crisis is done.
When asked if he would be willing to buy any Credit Suisse's assets, Winter said Standard Chartered is always interested in looking at things with a decent return. In North Korea, Kim Jong-un oversaw tests of weapons designed to deliver nuclear attacks against the U.S. and its allies. One of them was described as an underwater drone that can create a, quote, radioactive tsunami. The official North Korean news agency says the drone cruised nearly 60 hours before detonating. Now, the tests also included cruise missiles carrying mock nuclear warheads. And shares of Activision Blizzard jumped in pre-market trading. The UK's antitrust agency has narrowed the scope of its investigation into Microsoft's $69 billion takeover of Activision. The regulator now says the deal will not lessen competition in console gaming. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Like supervision generally, the stress test has become less rigorous over time. And I think, more importantly, it's become too predictable. And the whole purpose of a stress test is that you're trying to stress against the unanticipated, not the anticipated.
Which goes to the question, how do you stress test against a Twitter rant? And that has been sort of some of the questions. How do you anticipate the unanticipated? That was Dan Tarullo, former Fed governor, speaking on balance of power as we talk about bank issues and the concerns under the hood. One big question mark has been the value of real estate, in particular commercial real estate, not to mention residential, and particularly on the coasts. And there's no one better for insight on that than Jonathan Miller, president and CEO of Miller Samuel, who joins us right now. Jonathan, I want to start there. This question around commercial real estate values that a lot of people have been pointing to as a potential note of distress. How much is that true?
Oh, I think it's probably more true than we realize. The work from home phenomenon has fundamentally changed the metrics of commercial real estate. And the idea that people are going to return to the office 5 days a week is simply no longer a viable assumption. And we're already seeing that play out. In the security swipe data from Castle, we're seeing the numbers sort of stuck at about half, meaning about half of the buildings are being used compared to their pre-pandemic usage. And yet, at the same time, we're having residential real estate on the rental side in cities like New York, maybe not rising like they were, but remaining stuck at record levels. So there's this disconnect between commercial and residential as well.
There's a lot of issues to unpack there, and I want to start with this question of, well, if it's 50% occupancy, does that mean that you need to see a 50% decline in valuation for some of this office space in big cities?
Well, the short answer is yes, that's certainly possible. We're already seeing a significant drop. The numbers aren't reflecting that yet because with commercial real estate, you have people with 5-10-year leases at a rate that was market prior to the restructuring of pricing. So it's going to be a long process, but we're certainly seeing that. One of the reasons why landlords are unable to essentially, or why you're not seeing the market levels drop as much as they have been, is because they also have debt service to cover. And that debt service was based on the cash flows that existed before the reset in the whole market. So I think this is a long, slow process.
How much, Jonathan, does some of the concerns around recent banks, in particular Signature, which accounted for a significant part of commercial real estate lending in the nation, a disproportionate amount, how much does that accelerate this process?
I think it accelerates it probably at an uncomfortable rate to landlords themselves. They were the go-to bank for a lot of landlords with what are known as rent-stabilized apartments in the residential world, and it's one less lender to service to the business. So it is going to make things more expensive for landlords in that sector.
Can we dovetail this over into the residential sector? And you talk about New York, and I would pair San Francisco with that. I know they're unique stories, but some people would argue if office space is getting decimated and people are not going back to the offices, it also will let people live wherever they want. More people are moving to the south, to Florida, to the Sun Belt. At what point is this disconnect between residential in New York and commercial uncomfortable and needing to be bridged?
Well, I think it's already uncomfortable and needs to be bridged. But unfortunately, the solution for that is, I think a lot of people are sort of pinning their hopes on office or residential conversions from dormant office space. And the reality is that for probably 75, 80% of those buildings, it's unrealistic because there's a number of problems with that. The cost of converting to residential building codes almost from the start makes it a non-starter. The other is the debt that's attached to those buildings as collateral would have to be redone because it's a change in the status of the building. And I think one of the bigger problems is that the floor plates, especially in larger office buildings, aren't compatible. You can't create apartments that are 20 by 300 feet with 2 windows. So it is a major challenge. And I think we're going to be struggling with this transition or figuring out what to do over the next decade.
Jonathan, some people might listen to this and they might get a little nervous, especially with banks that are traditionally the disproportionate lenders to real estate investors of all types having issues and say, wait a second, this could actually portend a pretty significant downturn in tandem with what we saw in the housing crisis, particularly in areas that are big cities that typically have been office space havens that will no longer have the same allure. Do you agree, or do you think that there is some sort of buffer or something to kind of offset those gloom and doom prognostications?
I think it's an oversimplification. The way to think of it is, when you think about the banks that have actually failed right now, it's really a small number. And I think there's a concern that it could spread to other institutions. But at this time, we're not seeing that. So I think, this is sort of we're in a panic mode, and I think over the next couple of weeks, if nothing else happens, maybe that's indication that we're going in the right direction and out of the crisis.
Do you think that rents have to come down on residential, that you have to start seeing some more significant declines in the residential price tags in order to right-size things and bring something to a greater sense of stability?
Well, one of the problems with the rental market has been it was already tight, and the spike in mortgage rates, more than doubling over the last year, has pushed would-be home buyers into the rental market, which has exacerbated the problem. We have seen nationally residential rents begin to decline, and in New York, not so much. Rents have essentially been flirting with record levels since last summer. But the only way I can see rents fall in a meaningful way if we have some sort of recession or there's a much more damage seen in the employment sector. Because other than that, I can't think of a reason with high mortgage rates that rents would see a significant improvement in affordability.
Before I let you go, Jonathan, I'd love to talk about that mortgage rate, which has started to come down, especially on the heels of expectations of rate cuts. Where does the mortgage rate have to be to make the affordability proposition much more attractive to buy and send people back to that market rather than rent?
Well, I think any notch lower, improves affordability. But I think, that rates should comfortably sit in the 5s, in the mid-5s, and that be the new normal. The idea of 2.75 30-year fix is preposterous. That's not sustainable, and look where we are now. But I think mortgage rates that are somewhere between, somewhat lower than where they are, but rates are not too high. They're just too high relative to the unbelievable lows that we saw over the last several years.
Jonathan Miller of Miller Samuel, thank you so much. And I hope we can catch up again soon, especially as the real estate story does evolve. We do have some headlines coming out of that meeting in Brussels where we were talking with our own Maria Tadeo. Christine Lagarde remarking to EU leaders, this according to a person familiar with the matter, saying there is no trade-off between price and financial stability. This, of course, has been her line for quite a bit, saying that there is a need to progress on a banking union. This perhaps talks to the closing of the spreads in the periphery and this question of whether greater unity to fight inflation does lead to a closer union in Europe. Also talking about the euro area banking sector, saying it is strong. There is not a concern we are seeing right now. Deutsche Bank shares notching just a touch lower over in Germany, although still about down 12%. Barclays shares down almost 6%, and UBS shares off the earlier lows. But again, there is a feeling that perhaps there could be something that is playing out here, whether it's a recession trade or whether it is something more concerning about contagion. Coming up at 10:30 a.m. Eastern, Mark Lazary, co-founder and CEO of Avenue Capital Management, talking about the private credit impulse and how that plays at a time of potential liquidity mismatches and price distortions. From New York, this is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Equity futures down 5 or 6 tenths of 1%. The countdown to the open starts right now.
everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the bond market sending a message. The rate hikes are over. Secretary Yellen looking for new ways to say the same thing. And TikTok struggling to find friends on Capitol Hill. We begin with the big issue, testing the rally.
The market's been very resilient.
Equities are still fairly resilient.
The sell-offs we've gotten have been, fairly shallow, and people have been pretty happy to re-engage to the long side.
The Fed is up in the zone of being done, working on the assumption that one more hike and then we are done.
Folks do want the market to go higher.
Big picture, yields are high, and this market's going to be well supported.
The market is on a hair trigger waiting for the pivot.
I think there's no conviction.
The market has anticipated a lot of rate cuts this year.
People see, different statistics being reported from an economic standpoint.
The labor market is still overheated. Inflation is still very high.
And then they see stories about Credit Suisse, stories about Silicon Valley Bank.
The key question is, who is right in that scenario?
We've got a fantastic lineup for you this hour. It begins with JP Morgan's Kelsey Barrow, George Goncalves of MUFG. Kelsey, first to you. Was that last hike this week the last hike?
We do think that this may have been the last rate hike in this cycle. And I think the two-year yield is telling you just as much. In fact, it's 100 basis points inverted to the spot Fed funds rate. So the market right now, the Treasury market, is sniffing out this end of cycle. It is sniffing out the potential for rate cuts. But I would say the bright spot in all of this is that Treasuries and high quality, long duration fixed income is working as a ballast again in your portfolio for the first time. So we were here at the beginning of the year saying bonds are back. Now I would say bonds are here.
The 10-year down 12 basis points, 330. The 2-year 362 down 21 basis points. On the session, George, on the session, these moves are just nuts. They've been mental for 2 weeks. If it's the end of the rate hiking cycle, is it the end of the economic cycle?
Look, Jonathan, it might be actually worse than just the end. We could have experienced actually the Fed's equivalent of the Trichet moment this past week. And I think that's a big deal. I mean, collectively, the Fed had the chance. They were even contemplating on pausing, but the market had some priced in, and they delivered on it. And now you have the market actually going the other way. So are they going to start delivering on cuts? Because the market's calling for cuts as soon as the summer. And that's going to be a hard thing to kind of thread the needle on.
George, how can they cut with inflation at 6%?
I mean, look, traditionally, if this becomes a bigger banking crisis, if it truly is going to spread, banking crises are deflationary. They know that. They have experience with the 1930s. The Fed has always been more worried about the 1930s than the ECB, which has been worried more about the 1970s inflation. So if you really truly have a contraction of credit in the U.S., that will fix the inflation problem.
Kelsey, how much of a disinflationary shock are we seeing play out?
So we do agree with George that this banking stress and this tightening in credit conditions is going to be disinflationary. I mean, don't forget, credit conditions were tightening before the recent banking stress. Now we expect they're only going to tighten further. So, everyone's been talking about the Senior Loan Officer Opinion Survey. That's going to be out. And the way that they do it is they do the survey so that it's available for the Fed 4 times a year around the Fed meeting. So they will have it at the next meeting, and that's what they're going to be looking very, very closely at. They're not going to be looking at what is the backward-looking view, looking at the year-over-year rate of inflation at 5.4%. They're going to be looking at what are those forward-looking indicators saying about growth, inflation, and credit conditions.
So, Kelsey, what does the market feed on in the meantime? It needs to feed on something. It's not going to be CPI, won't be payrolls. We're ignoring jobless claims south of 200K. Do we just have to sit here and wait for the Senior Loan Officer Opinion Survey?
So in the meantime, I think what the Fed will be looking at is they're going to be looking at credit spreads. If you look at more traditional measures of financial conditions, they look fairly sanguine right now. But then when you look at spreads in the banking sector, particularly the level, but also the shape of the credit curve, it is still indicating a fair bit of stress, particularly with front-end bank bank spreads being wide. And what you're seeing in the reports from the Fed yesterday, on Thursday, they released the balance sheet data, is that banks still need liquidity. The liquidity crisis may not be getting worse at this point, but there still is quite a lot of demand for the discount window as well as the Fed's new borrowing facility.
With all this in mind, George, how desensitized will this market be to traditional economic indicators?
Look, I think Kelsey's absolutely right. We've been focused on these backward-looking indicators, and it's all about, passing the baton to these forward-looking indicators, especially the weekly updates we get from the Fed's balance sheet. 100% agree with that, as well as, the 2-week lag on the commercial banking data that we'll get also this afternoon. I mean, all of this stuff's going to be super critical. It's usually viewed from like a wonky lens, but considering that's like the most real-time data that we're going to get, that plus the volatility in bank spreads. I mean, all these things are telling you that we should take a pause and wait and see here. And I think the Fed's going to be taking notice of all this very clearly.
George, wait and see is very different to I've made the decision. After 2 weeks of this, the story has completely changed. Which one is it?
I think, look, if this does not stabilize once we get past the quarter, we also have a quarter end next week. If this were to continue into early April, I think the Fed would have to start to really rethink about what they do in May and June.
What is it about this, Kelsey, from your perspective, that you think this story now is firmly in motion? It's something that keeps on moving, rolling in the wrong direction?
Well, I think it's what we were seeing before all of this really started. So we happen to have our investment quarterly on March 8th, so right before all of this really unfolded. And at that time, we had very high conviction that there was a recession in the offing, particularly because the cumulative and lagged impacts of this most aggressive rate hiking cycle since the 1980s was ultimately going to bite. And so I think this really only reinforces the way that we've been positioning in portfolios, which is conservatively in terms of our credit positioning and in long duration in terms of our interest rate sensitivity in portfolios.
And you've been right to be conservative on the credit risk side of things, that's for sure. You and Bob Michael over the last few months. Equity futures right now, if you are just tuning in, welcome to the program. About 23 minutes away from the opening bell. Equity futures down about 0.6% on the S&P. A bit softer on the NASDAQ. No big moves here. We're down 0.4%. The big moves belong to the bond market over the last couple of weeks, that's for sure. In the bond market right now, 2s, 10s, 30s, look a little something like this. Your 2-year yield bound by 23 basis points to 360 on a 2-year, on a 10-year 330. The whole curve back with a 3 handle. At one point in the last couple of weeks, we were talking about the whole curve looking at 5%, particularly at the front end, and that story's totally changed. Now, George, let's revisit the recession conversation. It was depth, duration, diffusion. I want to talk about depth. A couple of months ago, people were lining up to say, this is going to be a shallow one. If we have one, it's going to be a shallow one because there isn't much leverage. Given the introduction of these new risks in the last couple of weeks, do we need to revisit that one?
I think we do. And I think this really puts pressure both on the administration, the Treasury, and really we should really cut the Fed some slack here. They're doing their job in terms of liquidity provider. This really is about getting confidence back into the banking system. But I think, unfortunately, the damage is done. There's been a kind of migration that's been set in motion. And if rates do stay in the cash side anywhere between 4 and 5%, you're going to see cash move towards the money markets. And so this kind of is it's kind of self-inflicted in many ways. But it won't be fixed by the Fed just slashing rates back down to 0. I mean, trying to reliquify the banking system through that approach will open up the whole inflation problem all over again. This is going to require some really creative thinking, not just a blanket FDIC approval, maybe perhaps thinking about targeting a mini type TARP for the smaller banks. I don't know, but I do think that they have to get more creative. And we've seen this in prior crises. They kind of slow walk the whole thing up until they actually have to do something very bold. It's time to get bold.
You mentioned the money market fund issue. The AUM surging above $5 trillion. This from Michael Hartnett, up more than $300 billion in the past 4 weeks. B of A's Michael Hartnett pointing out that the previous 2 surges, 08 and 20, coinciding with big Fed cuts. Now, Kelsey, I just want to come back to the rate cutting cycle. I get it. This market's screaming to the Federal Reserve, you're done. the cuts are coming. We don't think you can get to 5.1%. Even if you do, you're not going to be there very long. I understand all of that. Kelsey, when they start to pull back, if indeed they go in that direction, what are they coming back down to? And just please contribute to that conversation George and I were having about the depth of this recession call. Does that need to be revised?
Yeah, so I would say when we think about where the Fed could cut to, we are not expecting that they're cutting back to the zero lower bound. We do think that when they cut, there are reasons why it's not going to be all the way back to zero. But I will say that with this surge in money market funds, I think investors need to be a bit cautious because those instruments are going to have a lot more reinvestment risk once the Fed starts cutting. So you're going to get 5%, but you may only get that 5% rate for 3 months. And if that's the case, you're not actually getting a 5% return because that's an annualized return. You're really only getting 1.25%. And so that's why we're very focused right now on communicating to clients the benefit of locking in those yields at this moment, particularly as those risks, as you mentioned, of the hard landing continue to increase. The severity of that recession could be worse.
Well, Kelsey, this call then is relative to where you think Fed funds gets pulled back down to. So for me to understand how much value is in a 2-year at 360, if you tell me we're not going down to zero, what are we going down to? How much value is in 360 on a 2-year if I'm locking that in for the next couple of years?
So that's a really good question, and there's two things that you need to assess in terms of the valuation of the 2-year. So one, right now we're seeing a huge flight to quality bid, and it's being concentrated in the 2-year. So that's essentially a bit of a risk premium that is somewhat disconnected from what the future path of the Fed funds rate is going to be. Secondarily, even if the Fed only cuts to 1 or 2%, it's the speed in which they cut. And so obviously, if you look at the WIRP page, it's changing every second. But historically, what you've seen over the past few days is the rate cutting cycle that the market is pricing is still fairly, gradual and measured. Generally, when the Fed actually starts cutting, it ends up being quicker than that. And that's what ultimately results in a lower fair value for the 2-year yield.
The way this conversation has changed, the tone of it in 2 weeks is just absolutely stunning. Kelsey Barrow, George Goncalves sticking with us. Equity futures right now down 0.6%, with some movers going into the open. Here's Katie.
Hey, John, let's start with First Republic because shares are back under pressure this morning, even after Secretary Yellen clarified her comments yesterday saying that regulators are prepared to take additional actions for depositors, but this bank has been downgraded multiple times over the past few days, down more than 45% this week alone. Moving on, Block, it's building on yesterday's sell-off after Hindenburg Research came out with a short report against the payments company. Of course, Block has called those allegations misleading and inaccurate, but you can see shares continue to fall, down about 1.4% pre-market. And finally, I want to get a check on Microsoft after the UK's Competition and Markets Authority said that new evidence showed that Microsoft's acquisition of Activision Blizzard will not result in a substantial lessening of competition. You can see Microsoft down slightly, Activision higher.
Katie, thanks for that. Thank you very much. Coming up on this program, Secretary Yellen looking to reassure markets.
The strong actions we've taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
That conversation up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Connection lost.
Bigger challenges next.
Was going to keep Great World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
As I've said, we have used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we have taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
Same message, different language. The latest line from Secretary Yellen aiming to avoid a repeat of recent volatility as she closes out 2 weeks on Capitol Hill. The bank's seeing little relief from her reassurance, hitting their lowest level since November 2020. Lenders both big and small now coming back under pressure in pre-market trading. Team coverage begins right now. Down in D.C., alongside Katie Lyons, Bloomberg's Anne-Marie. AMH, first to you. Yellen seemingly finding new ways to say precisely the same thing.
Yeah, it was a bit of a tweak in language, Jonathan, wasn't it? We should quickly just outline exactly what the language has been. So on Wednesday, in her testimony, she wanted to make sure she was reassuring the markets. She said the federal government's recent actions have demonstrated our resolute commitment to take necessary steps. It got a little bit more tricky then in the Q&A. She was asked about Congress and what they should be doing with the FDIC, and she says she's not considered to discuss a, quote, blanket insurance. The market obviously took note of that. We saw bank stocks fall. So then yesterday she came in and said, certainly we would be prepared to take additional actions if warranted. All of this is really about the language and the semantics. We know the Treasury Secretary or those under her were looking at emergency measures they can use, temporarily potentially raising that cap for these depositors. But when it comes to a blanket response or changing it broadly for good, that lies in the hands of Congress. And this is a debate that is taking place right now.
That's the point of tension, and it's a really important distinction you've made, Anne-Marie, throughout the whole of this week. Kayleigh, First Republic down 4.9%. It looks like it's going into the weekend without a new solution.
Yeah, it's been eerie how little news there has been in regard to First Republic. And I keep asking sources down here, is no news good news or is no news bad news? And no one really seems to have an answer because by and large, the thinking is that this bank isn't going to be able to make it without some kind of intervention, given how in the hole they are at the moment. So that is why we see the stock under continued pressure. It is not alone. You are seeing other regionals down in pre-market trading as well, although these losses really do look relatively mild compared to what we have been seeing for these names in recent weeks, because as we well know, First Republic is down about 90% over the last 3 weeks at this point. Its price to book ratio has just fallen off a cliff. The stock is now trading at a 1/6 of book value. Absolutely brutal. The, of course, concern here is around those deposit outflows. It doesn't seem that the words of Treasury Secretary Yellen are doing enough to quell concern around that, given that would be a reactive action by and large if they see systemic risk being present, not a necessarily proactive one to prevent that deposit flight from happening. So we have to keep this in mind. And of course, for traders looking at how this relates to the economy and ultimately monetary policy, the thinking seems to be, we're looking at the banking system, hearing you say you're not going to cut this year and thinking you are wrong because the real tightening in credit conditions is happening. Hence why we're seeing 2-year yields falling off a cliff, John.
A break of 12 on First Republic as well. That big move in the bond market. Kelly Lyons, Anne-Marie, to the two of you, thank you. So in the bond market, the front end of the curve right now, the 2-year is lower by more than 20 basis points. First Republic, it's a break of 12. It's 11.97. George Concalves, Kelsey Barrow, back with us. Hey, George, earlier this morning, the German central bank governor, the president of the Bundesbank, was talking up, speeding up QT in Q3. talking up more rate hikes. What do you make of the split right now between them and what's happening here?
Look, again, this issue is really primarily still a U.S. issue in terms of the deposit flight and the losses that have been built up in the AFS and held to maturity for a lot of these small and mid-sized banks, where it's a different story for Europe. But I mean, I do think if they were to continue to tighten, it's all about what the yield curve does over there in Europe. I mean, we've had a big move today in global rates. Really, that's what kind of triggered the lower move here in the U.S. as well. So they can, again, they'll suffer the same problem the Fed has suffered, which they can push up the short rate as high as they want. But if the yield curve does not participate in Europe, it's really not going to work out.
Let's talk about the curve here, stateside. Kelsey, your thoughts on this one? 2 Wednesdays ago, feels like a lifetime ago, but 2 Wednesdays ago, we had an ADP report. And I remember the price action after that, the yield curve aggressively, deeper inversion came through, negative 110. And this morning at one point, as high as negative 26. Kelsey, where's that one going?
So we are positioned in terms of our rates trades in an end of cycle trade. So that's long duration and that's yield curve steepeners. So we do think the path for the yield curve here is actually to continue to steepen. So what we see is there tends to be this very quick shift, and it tends to be quick in every cycle, where you go from very aggressive yield curve flattening to a bid in the 2-year yield that drives the yield curve steeper as the market anticipates rate cuts.
Do I want to be sitting in risk assets, George, while that's going on?
No, you don't. Historically, whenever we get the curve to steepen this quickly, and let's be honest, this was a hyper steepening because it happened in a 2-week window. The days before we're at 5% 2-year notes, and 3 days later we're sub 3. I mean, that's just one of the fastest steepening type moves in unwinding of the flattener, which was a persistent flattener for nearly 14 months, right? We had a big flattener across the curve, then every single part of the curve was flat and inverted. Now that we're trying to get back onto the other side and get into positive slopes, that only happens if the Fed participates and cuts rates, right? So this is a signal that you only cut rates if something's starting to break down even further, not just the banking sector, but the economy as a whole.
So, George, let's build on this. I want to finish on something we touched on a couple of times in this conversation together over the last 20 minutes. This has happened really quickly in a little more than 2 weeks, and we're unwinding huge positions in the bond market. And I think to some extent, extrapolating out the current experience, extrapolating that out through the rest of this year. George, you mentioned solutions for the banking system. Is there a solution you can think of that takes us back to the world we were living just a couple of weeks ago?
Unfortunately, I don't think there's a silver bullet. I think it has to get either worse or it has to get prolonged enough that it actually encourages some real policy decisions out of D.C. that are not just against the blanket FDIC is a good first step, but I'm not sure if that's enough. I think it really comes down to what's the role of these smaller banks? How are they going to fit into the financial landscape going forward? And do they need to at some point get capital? Because the Fed can give liquidity for a 1-year window. What happens 1 year from now? Their own forecasts are showing weaker growth in 2024. They think this is going to be a very shallow recovery once we come out of it.
Hey, George, wonderful to catch up as always. George Goncalves there, and a brilliant Kelsey Barrow on the situation in the bond market, the global economy, and in equities as well. Equity futures right now down 0.75% on the S&P. Going into this opening about 7 minutes away. Your bond market, bid. Monster rally again. Yields lower by more than 20 basis points. 362 on a 2-year. We're getting used to moves like this, aren't we? Don't get used to moves like this. It is not the typical thing you see in the bond market. It is very, very unusual to see this development consistently over the last couple of weeks, from north of 5 to well south of 4 on a 2-year to about 360. Coming up, the morning calls, and later, banking fears tightening its grip on the sector. We'll get the view from Lafayette's Christian Mamani and Keith Lerner of Truist. That conversation coming up shortly.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Equity softer, let's get you some morning calls. First up, Atlantic Equities downgrading Block, saying the company failed to deliver a thorough rebuttal to the Hindenburg report. JP Morgan upgrading KB Home, highlighting the company's solid results. And finally, RBC cutting its price target on Goldman, expecting a deep recession to accelerate credit losses. That stock is down to 310 in the pre-market, down by about 1.5%. Up next, global bank stocks resuming their declines. That conversation with Lafayette's Krishna Mamani and Keith Lerner of Truist.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Of the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
2 weeks of banking turmoil, and before today, we were poised for a second week of gains on the S&P 500. We're going to take a bite out of that at the opening bell. Equity futures right now down 0.4%. On the S&P, on the Nasdaq, we're negative 0.25%. The drama kind of fades just a little bit going into the cash open. There's the opening bell. Switch to the board and get to the bond market. Plenty of drama there. We're down 11 basis points on a 10-year, 331.31 on a 10-year yield, on a 2-year yield. Absolutely plunging. Bramo a little bit early this morning, so the 2-year yield was dropping like a stone. It is. We're down more than 20 basis points at the front end of the curve. Bit of dollar strength out there. Euro weakness. Euro dollar 107.59. We're negative 0.6% for the euro against the dollar. And in the commodity market, down by more than 2 percentage points. 68.40 on WTI. About 25 seconds into the session, equities look softer by only 0.4% on the S&P. On the Nasdaq, we're down about 1/3%. Call it negative 1/4%. One stock to watch at the open, First Republic, extended its declines through the morning as investors digest Secretary Yellen's latest comments on Capitol Hill. Kaylee has more. Hey, Kaylee.
Hey, John, yeah, this stock down about 5%. So just adding to the losses it has already seen that have been substantial over the last 3 weeks. We're talking in the ballpark of about 90% over a very short period of time. Really what we're all wondering is when Janet Yellen says they will take additional action if warranted, is this going to be one of the banks where that action is warranted? Because remember, over the course of the last week, we have had news that 11 larger banks put $30 billion of deposits into First Republic to try to stop the bleeding. It didn't have the desired effect. Then there was the conversation around potentially converting some or all of those deposits into a capital infusion, the government possibly having a hand in that deal. And yet we haven't actually got news on it. For a crisis that has moved very quickly, it seems that anything around this name is moving quite slowly. So we are all still waiting for news as the losses steepen here. And of course, we also got news on this name. The only real news we've gotten is the fact that we've had 4 credit downgrades in the span of a week. The latest came on Wednesday from Fitch, and they specifically cited the altered balance sheet, essentially. The fact that you're seeing withdrawals of deposits and it's being replaced by really costly borrowing, primarily from the Fed's discount window that banks, not just First Republic, but largely have had to tap for liquidity. That is reflected in the numbers. We had that record $153 billion in borrowing from that lender of last resort last week. It did come down in the data we saw yesterday, the week through Wednesday, to just $110 billion, but still that remains quite elevated relative to history. So it just goes to show you that there is still funding stress out there for these banks. Very unclear at this point how close we are to the end of this particular episode.
Hey, Kaylee, thank you. Let's pause. Look at this move. Let's get First Republic up again. It's a break of 12. First Republic is negative this morning once again, down by close to 5%. Given what we've seen develop over the last couple of weeks, 5% on this stock is like nothing. But look at the fact that it's at 12. Call it 11.90. Go back to March 9th at the opening bell. That stock, triple digits. Triple digits. This mess started really after the close on March 8th. March 9th at the open, triple digits. Here we are at 12. It's been a problem for a couple of weeks. The problem continues. The bank rout deepening across the Atlantic as well. UBS shares dropping after Bloomberg reports that the DOJ is investigating whether it's among the banks that helped Russian oligarchs evade sanctions. Jan Patrick Barnett joins us now. Jan, let's talk about this. This is why they wanted the government guarantee. You never want to inherit someone else's legal problems. How big might they be?
Yeah, that's absolutely true. And we know that Credit Suisse has a reputation for not doing business always by the book, so that could become a problem for UBS down the road. The two lenders have now to pull off a mega merger with lots of uncertainty in there. And the last thing that you want to have is some uncertainty, especially on the legal side, that is interfering with your efforts to align those two big operations, and certainly making investor nervous about more bombshells lying down in the cellar.
You and I have been talking about Deutsche Bank, another name, throughout the whole of this morning. Let's go back and forth on it again. DB's down about 10% or so. I'm trying to work out, Jan, what's driving the move this morning. Is this just general risk aversion across the whole continent, or is there a reason why Deutsche Bank's getting hit specifically so hard?
Well, I would say like there's a little bit of both in there, right? So it's not that Deutsche Bank is like the main problem child here. We see a bigger risk-off move in European assets and stock markets, and banks are getting hit across the board. Last week it was Societe Generale and BNP being the underperformer. This week it is Deutsche Bank. Of course, we know that Deutsche Bank had problems with like capital and their business model back in the day. So it's always like kind of a first choice for investors when they want to reduce risks. But I would say like this move that we are seeing is much bigger and much broader in terms of people positioning for a recession, and in this term for banks also positioning for earnings contraction rather than like a massive hit to capital or any liquidity issues or any instability in the banking sector as a whole.
That's where the underperformance is this morning over in Europe on Deutsche Bank. Jan Patrick, thank you, sir, as always. Deutsche Bank negative, close to 10%. UBS negative as well. UBS also on the receiving end of a downgrade this morning. Jefferies cutting shares to hold and writing the following. UBS was forced by events into this Credit Suisse deal. Negatively, it changes the equity story of UBS, which was based on a lower risk profile, organic growth focus, and higher capital returns. All of these elements, which is what shareholders bought into, are gone and likely for years. That sounds like a sell, not a hold, but it's a hold from Jefferies on UBS. With us now, Lafayette's Krishna Mamani, Keith Lerner of Truist. Krishna, you've been great over on Twitter. I've been following your tweets on the banking situation, and there was a line you used, Krishna. The crisis isn't about deposits, it's about cheap deposits. Krishna, what did you mean by that?
Well, so if you look at the situation, if you are looking for replacement for your liquidity, you have BTFP and you have a discount window and you have Federal Home Loan Banks to kind of provide you that liquidity. The problem is that that liquidity comes at market rates as opposed to coming at 0% or 1% kind of a rate. And if you are having a problem in your books because of profitability, that is getting exaggerated. So what we are quickly transitioning from a liquidity crisis to now a profitability and capital crisis. That's at the end of the day, if left unchecked in 6 months' time, that's what we'll be talking about.
Well, the key caveat there, if left unchecked. Krishna, what can they do about it? Do rate cuts? Are you suggesting rate cuts can address this?
Well, rate cuts could certainly address this to some extent. However, I don't see that forthcoming anytime soon. I think Jay Powell made that amply clear. I think vulnerable banks will have to come around to raising some capital relatively quickly and not wait till the day of the crisis like SVB did. So I think at the end of the day, if you want to save your bank, raising some capital at this point, even if it is at a huge cost in terms of dilution, that's something that you have to contemplate. That really, at the end of the day, is the solution.
Keith, two issues. One, some of these names face an existential crisis. We get that. But two, the broader sector, given recent developments, is going to face real profit headwinds. How investable do you think this sector is right now, from your perspective?
Well, I think it's going to be challenged. I think, as far as the one thing that's been discussed, probably ad nauseum, was that lending trends were becoming tighter even before this happened. Lending trends are only going to become tighter. There's going to be more regulatory scrutiny. And I will say, I think part of the challenge with this market is, like, yesterday you made a 2-year low in the U.S. bank index, and now you're also seeing that this morning overseas. So, you think about credit's the lifeline of the economy. We think recession risk is relatively high later this year. And even if the Fed cuts rates, we don't think that's going to change the trajectory. And all you have to do is look back at 2007 or 2000, knowing those were different situations than today, to see just because you cut rates, that is not a panacea for either the economy or for the overall market. And therefore, from an overall strategy standpoint, Jonathan, we still remain defensive.
So, Keith, it's never just about the data. On this show, we always say it's not just about the data, it's about how the market responds to that incoming information. Keith, last time you and I spoke, we talked about what you called the reverse Tepper trade, where basically bad news was bad news and good news was bad news. What is it now? I'm trying to understand how this market is going to respond to incoming information in the weeks ahead, given the introduction of these new risks over the previous 2 weeks.
Yeah, I think, on the reverse Tepper trade, I think the bad news is that more likely the economy is going to slow down, and along with those tighter credit conditions, profit trends are also going to weaken as well. What's curious to me as I look at the earnings growth or the estimates for the second half, analysts are looking for the S&P earnings to make all-time earnings high as far as on a quarterly basis in the second half, and that's just not consistent with an economic slowdown that we see. So the other thing I'll say, Jonathan, too, is if you look at right now, all the things we're talking about, I think it's hard to argue that we don't have above average macro risk, right? equity markets and credit markets are trading around average. So why are the markets trading around average when we have above average risk? Our view is they shouldn't be, and therefore, again, I think there's some downside risk both to credit and also equities more broadly.
Krishna, do you agree?
Well, I think there are substantial risks to both credit and equity for sure, given the way things are trending. But I would caution here that drawing too many conclusions from the bond market reaction for equity market, at least at this point, may seem a bit premature. I think what Powell did was basically told the bond market that the risks for now are really one-sided, which is rates go down because of a tightening crisis, or the credit conditions tightening. So I think bond market takes that clue and runs with it, and that's what they're supposed to do. Whether that will be validated by data, I think, is an open question today, and I think that's why, and that's what the equity market is thinking about. So it may come about that things slow down catastrophically, but it may also come about that things don't slow down as much as the bond market is fearing today.
Well, Krishna, you just said something interesting. You said whether that will be validated by data, and the first thing I thought of is what data? Are we going to pay any attention to incoming economic data points for the next month, the next 2 months, as we wait to see what the consequences were of the previous 2 weeks and what's about to come from the banking system?
I think we are probably going to discount near-term data, especially sort of pre-March data, as lagging data for sure, and that's what we are supposed to do. Having said that, I think if the growth trend or employment and hourly earnings and other things kind of continue to reinforce the point that the economy is not slowing down the way the 2-year notes would have you believe, I think that cannot be ignored for too long. We can ignore it for a couple months, but I think if it persists, that will not be ignored.
This is what Jim Bullard's got to say. First Fed Speaker of the Week, post-Chair Powell hits the tape. Bullard says this: inflation remains too high. The St. Louis Fed president goes on to say it's appropriate for monetary policy, that it can keep lowering inflation. Macroprudential policy can contain financial stress. Keith, what are you looking for in the Fed speak in the coming weeks, and how relevant is it, given that this market is just living in its own world and trading on the future and discounting what it thinks is going to develop, which is ultimately an economic downturn off the back of financial stress, which delivers a disinflationary shock and tighter financial conditions?
You know, I think, Jonathan, I mean, before you even say what we're looking at, even if the economy doesn't slow down as quickly as maybe some folks are concerned about, you're already, in our view, trading at optimistic levels given the outlook. I mean, you're trading at above a 17 multiple for the S&P. If you look at high yield spreads, they're around 500. During a recession, the average is about double that. So to us, I think we're not really pricing in that much bad news more broadly. And then you look at the the S&P and look at the sectors. Technology is leadership right now, but it's trading at the highest premium in about 20 years. And then you look below that, the defensive areas aren't acting great, and we're seeing cyclicals come down again. So, as far as what we'd be looking at, I think the initial jobless claims will be important to validate that the economy is going to slow down. But our point of view is all this what we're talking about today. To us, not a lot of that is actually priced into the market today. It's to us still somewhat complacent relative to the news. If the market was marked down because sentiment is really negative, we would be much more positive here. We're just, we're not seeing it in the valuation data.
Krishna, something Jeff Rosenberg of BlackRock said earlier this week, I think you'll appreciate. The risk cuts both ways. We're all sort of focusing right now on the issues that have developed over the last 2 weeks, that it's going to develop tighter lending standards, financial conditions, disinflationary shock, all of that stuff, all the bad stuff. What we're not focusing on anymore is this idea that the Fed may have to stay here, stay where rates are, because inflation is going to be sticky through the rest of this year. Krishna, how much of the latter view do you think we need to pay attention to?
Yeah, so I think Rosenberg is a smart guy. So I think his point is a very valid one. That is, what we are reacting to is really a banking crisis, and the banking crisis may actually have a significant impact on credit conditions and growth outlook today. But saying today that what has happened in the banking sector may lead for the Fed to be cutting rates in June or May, I think it's a bit of a stretch at this point. And market is leaning one way hard, probably because of positioning, especially in the bond market. And I would guess that at some point that rectifies itself in not too distant a future.
We'll see. Hey, Krishna, this was great as always. Alongside Keith Lerner, Krishna Mamani there. 14 minutes into the session, your equity market shaping up as follows on the S&P 500, down about 0.7%. Coming up, TikTok in the hot seat.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it.
How would you describe it? That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet, with guests like U.S. Special Presidential Envoy for Climate Change, John Kerry.
Climate has no affiliation with any party or ideology. Listen to the scientists. This is not a matter of ideology. It's not a matter of politics. That's the challenge.
Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it. I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
But you know what? I find that actually preposterous.
What a grilling on Capitol Hill. He never had a chance. The TikTok CEO facing off there with lawmakers in Washington. His testimony failing to satisfy officials eager to ban the video sharing service. Team coverage begins right now with AMH in Washington alongside Mandeep Singh here in New York. Anne-Marie, first to you. That's not how I would describe it. Those words, brutal.
It was brutal for him. The criticism just would not stop. He didn't get a moment to breathe. This was more than 4 hours of questioning and all these lawmakers critiquing his company. But Jonathan, there's really not much we learned from yesterday, except for the fact that bipartisanship, when it comes to this vitriol and concern about the TikTok app, that is alive and well in Washington. What really was key yesterday was what happened before CEO Shou Chu arrived at the Capitol, and that was the statement from China's Commerce Ministry saying that they would have to approve any sale for TikTok. And this just really undermined his entire testimony because lawmakers were trying to draw that link throughout this 4.5-hour hearing that TikTok does have some sort of link with the Chinese Communist Party.
Mandeep, if you're Meta, if you're Snap, you must have enjoyed that yesterday.
I think so. And look, when it comes to video content, even though Meta has, 2 billion daily active users, TikTok is where most of the video content, user-generated video content comes from. And that's why, the platform is so powerful is because, it has that engagement. So if you're a Meta or a Snapchat, you want to bring more creators on the platform. And this is the type of thing that can, shift the creators towards a new platform. Now, we did a survey where we found YouTube is still the preferred platform as an alternative to TikTok because YouTube has a revenue sharing model there. They share the revenue with creators. Meta and Snap don't do that. So we still think YouTube will be the biggest beneficiary if there was a ban on TikTok.
Those year-to-date moves for some of those names, wild, just monster moves. I want to come back to you, AMH, just quickly. Just got a headline that Secretary Yellen is convening top regulators. What do you make of that? How important is that issue?
Well, she's meeting with them this morning after we go into this third week, right, Jonathan, of this concerns and contagion in the banking sector. Obviously, there's concerns still about U.S. regional banks, First Republic being top and front and center. But then also there's concern about what's going on with Europe, with Deutsche Bank also deeply under the weather today. So she's meeting with these top regulators, not sure exactly what is on the agenda, but we look forward to see potentially any readout this afternoon from the Treasury Secretary.
It's not how I would describe it. I'm still trying to work out how we would describe it. Anne-Marie, Mandeep, forgive me, I'm going back to the TikTok story again. Breaking news just about 5 minutes ago. Let's get you some data. Here's Mike McKee.
All right, John, the S&P Global PMIs are out for the United States. They are all better. Manufacturing at 49.3, up from 47.3. Global services, 53.8 from 50.6, and 53.3 for the composite. That's up from 50.1. Basically the same story we saw in Europe, where all of the manufacturing indexes remain below the 50 level, but all of the service industries are above 50. Also, we have some headlines out from Jim Bullard, basically saying Fed did the right thing. They had to separate the financial crisis from the inflation crisis. He says financial stress can be harrowing, but tends to reduce the level of interest rates, which could help the banks overall.
Mike, this week is never ending, isn't it? I imagine we'll get more Fed speak over the next week.
It's not.
It's got to end at some point. I feel like it started like March 8th, and it's just kept going. Mike McKee, thank you. We've got about 22 minutes into this session. Gone about 22 minutes into this session, and equities are down 0.7%. Katie has some sector price action. Hey, Katie.
Hey, John. Well, really quickly, let's look at those sectors. You can see utilities, consumer staples managing to stay in the green this morning. What's more interesting maybe is the losers. You have energy. That's been under pressure all week. Financials also under pressure, down almost 2%. If you look back over the past week, though, we know that yields have just absolutely plunged. An interesting response, though. You have tech higher, as you might expect, but utilities, real estate under pressure, not exactly the response you would expect.
Katie, thank you. Up next on this program, the Trading Diary, just to get you to the weekend and perhaps get you there quicker.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
We're 25 minutes into the session. We're down about 0.5% on the S&P. We're down 0.2 on the Nasdaq. That's the price action. Let's get to the trading diary. How do you stay out of trouble? You schedule a meeting with a Canadian leader. It's always safe that way. President Biden meeting with his Canadian counterpart at 11:30 Eastern Time. Fed speak picks up on Monday. Fed Governor Jefferson, plus we'll hear from Barkin, Collins, Williams, Waller, Cook throughout the week and a whole lot more. You get 2 days of congressional hearings on Silicon Valley Bank kicking off on Tuesday. Fourth quarter GDP, another round of jobless claims on Thursday. And we close out the week with the Fed Vice Chair for Supervision, Michael Barr's testimony on Capitol Hill. Look out for that. If you can, enjoy the weekend from New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time. So you need to be global and local at the same time.
take your...
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open...
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure
unhappy. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe.
Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually
part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwist, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. And class? One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, we brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, that the traditional Indian sport. we have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit.
and the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country, the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via. She is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very